Well, most folks who do the sort of thing that I do here on YouTube are probably going to be talking about Super Tuesday today, because that is today. However, fail to see how that is the biggest story of the day, because, frankly, something much more important and impactful, something that will have a lasting impact. Not that Super Tuesday won't have a lasting impact. Obviously, it'll greatly affect the direction of the presidential races here. But something that'll have an even bigger impact on that presidential race, I think, is the ongoing economic unraveling. And I feel a little more confident in saying that today, because not only did we have that massive sell-off last week, and then on Monday, we had a very violent, rally back. The greatest percentage increase for the Dow Jones index since 2009. And again, I normally don't like to quote the Dow, but the only reason I do is because that is the only one that broke that record, that had that record yesterday. Of course, that's partially because of how the Dow is calculated, but I don't want to get into details about that. But anyway, a lot of people were feeling very smug yesterday. You had lots of Republicans coming out and folks on Fox, and I listened to Limbaugh and a few of the other folks on radio. They were sounding very happy, saying, "Oh yeah, you were a couple bad days in the stock market last week, but look at today, everything's better." And of course, they're saying things are better because of Trump. And of course, really, I would say that the stock market is very much a function of Trump. I think that stocks would not be where they are today had he not been elected in 2016. However, you want to be very careful in meting out credit and blame for the stock market, because of course whatever credit they're giving him for the good parts will inevitably turn to blame when things turn sour. And I think things have turned. People don't seem to realize that. The folks in the pro-Trump sphere, they seem to think that Trump can just somehow browbeat the stock market into not going down before the election. And he's having some success in that he was able to browbeat Jerome Powell today into cutting rates by 50 basis points, which, by the way, is the biggest cut since it was Bernanke cut by 50 basis points back in August of 2007. It's a very similar script playing out now, to where the Fed came in with a surprise 50 basis point rate cut, which is really two rate cuts, because a normal Fed rate cut is only 25 basis points. For those of you, who don't follow the inside baseball, that 25 basis points is 0.25%, 0.25%. A basis point is just a hundredth of a percentage. And so the Fed came out today and cut by 50 basis points, and this is supposed to, juice the stock market higher. This is, they don't say that this is why they do it, but really this is why the Fed is doing it. They're trying to calm down the stock market. They're trying to tell people, hey, don't sell your stocks. Here's some more liquidity, because the market knows at this point that when the Fed cuts rates, who that benefits. When the Fed prints money, the folks that benefit from that are the folks on Wall Street, because that money, and people argue about the transmission channels for monetary policy, but it seems like that money flows into the stock market, whether that be in the form of higher interest rate or of lower interest rates, enabling corporations to issue more bonds, to borrow money to buy back their own stock and drive up stock prices, or some other mechanism. When the Fed has low rates, that seems to benefit the stock market. And so the Fed was hoping, if they had this really extreme cut, and this is a big cut, a 50 basis point cut, that would shock the markets higher, just like that they did on Monday. But in reality, what they did by I think that the Fed actually cut too early, at their own game. Not that I think that that I really support their strategy overall, but I'm saying within, what their goal set is, even though they have a skewed idea of what they should be trying to achieve, because of course the Fed thinks that their job is to prop up the stock market. I think that's nonsense. I'm one of those old school guys that believes in market capitalism, to where prices should be determined by supply and demand, not by a Politburo, which is exactly what the Federal Reserve Board is. But they don't think that way. They think that their mandate essentially is to prop up the stock market. So they thought that, hey, we cut by 0.5% by 50 basis points. This is going to juice the markets higher, and we'll be, hopefully back, even with last week, and we'll be able to erase this terrible correction. But in fact, I think that they shot themselves in the foot, because the market already anticipated that the Fed was going to cut by 50 basis points. That was baked into the cake. The Fed funds futures had already implied a 50 basis point rate cut. And so that was already priced into the stock market, meaning that once the Fed cut rates, stocks could not go up based on that. They were not going to push rates higher, or they were not going to push, the stock market higher by cutting. The stock market already priced it in. So what happened when the Fed finally did cut, well, I say finally, but 2 days after people started expecting them to, when the Fed cut today, the market sold off, because people who had bought into the rally yesterday, who bought in anticipation of the Fed cutting rates, then sold the news, because that's a common trading strategy in Wall Street. If you hear a rumor, you want to buy the rumor, and then when that rumor turns into fact and it gets reported, you sell it. And the reason why you sell is because the gain that you are anticipating has been realized. You are only buying, waiting for that good news to come out. And then once you have that good news, you don't want to keep holding on to that stock, because there's a risk that it could go down at some other point because of the changing news. So that's how, that's just how trading works. And so the Fed was dumb enough to play right into, the short-term traders' hands. This was hot money that flowed in yesterday. These were not folks who were buying in for the long haul because they thought, oh, the correction's over, so I'm going to buy the dip. No, they were buying the rumor that the Fed was going to cut rates by 50 basis points. And that was the mistake that Jay Powell made today. And so in addition to that 50 basis point rate cut, the Fed also did a massive amount of repo today. They injected $120 billion into the repo market, which, again, is just more liquidity into the banks. They're giving away free money to hedge funds and banks. And they gave away $120 billion today. And it was oversubscribed, meaning that more people needed that repo money than the Fed was offering. $180 billion in repo were subscribed, meaning that was how much the folks demanded. And the Fed was only handing out $120 billion. And so, considering all this that happened today, the fact that the S&P was down by 87 points, almost 3%, is catastrophic, because think about how bad things would have been if the Fed had done none of this, if the Fed hadn't done this massive amount of repo and cut rates. At least that's going to be the perception by a lot of people. Obviously, I don't agree with that, because I think the market would have done better today had the Fed not cut. But it's really bad for the market. It makes the Fed look really bad. If the Fed comes out and injects all this liquidity in the market and cuts rates, and this, not only does the market finish red, does it close down, does it close lower than when the Fed announced this rate cut, but it was a significant decline, almost erasing most of yesterday's gains, meaning that we're almost back to the weekly lows. Now, the bulls and the bears on Wall Street were really duking it out today, because they were fighting over a very specific price range, and that range, that's in the 3,000 point range on the S&P. It's a big battleground, and of course, if you look at Sven Henrich's Twitter, you'll see that there's important structural reasons and support in the market of why this is such an important area, and things are not looking good for the bulls, because they really needed to break up above this range, above this danger zone, and they tried to do that today a little bit. We were green for some time, but then markets puked. And while I would have anticipated, some people to sell in response to the Fed rate cut, of people selling the facts, so to speak, the fact that there was so much selling, to me, signals that the Fed's monetary policy is losing efficacy. The fact that so many people, that such a substantial portion of folks who bought in yesterday were buying not because the Fed, the rumor of the Fed rate cut was inspiring confidence in them, but rather because they were just buying the news in a short-term trade. It signals that the Fed is not inspiring confidence in long-term investors. But of course, there's precedent for this, because last year, when the Fed was cutting rates, they cut rates quite a few times last year to try and save the market from the last really big correction, which was pretty much a bear market. They saved it right at the end. The markets were down 20% at the lows, if you'll remember, in 2019, just about there, right in the range of 20%. And the market bought, and people bought in and rallied every time that, in anticipation of the Fed rate cut. But every single time that the Fed actually cut, the market sold off. Every cut by the Fed was sold. So why the Powell would go ahead today and actually, so quickly offer this cut, I don't know why. Because frankly, the way that in 2019 he was able to string the market along was by going a pretty decent amount of time in between the rate cuts, so that the market had time to rally really high, so that by the time it sold off, it didn't sell off all those gains. But in this case, because we went so quickly from the time that the market started to anticipate and began to price in a Fed rate cut, and then to the next day the rate cut actually comes, the amount that got puked, the amount that was sold off, pretty much crushed all of those gains. And so what do we have left now? The Fed has, I believe, 125 basis points left of interest that they can cut before we get back to zero, which is where we were at not too long ago. And since that's the case, if 2000 and 2008 are any precedent, that's not enough space for the Fed to cut to, I guess, stop the bleeding, because the Fed had to cut by 500 basis points, i.e. 5% total, to get the markets to stop cratering the last two times around. But they can't cut 5% now, not unless they go negative. And of course, we've seen in other countries, we've seen in Europe and Japan. Once you go negative, that's a place you can never go back to. You go back to you go to negative, you end up with permanent stagnation. That's what we've seen. We haven't seen good results out of negative interest rates. So if the Fed wants to go that route, I guess they can. But it'll be the end of growth in America. And so these are trying times for the American economy. There's certainly trying times for the President of the United States, who, against all my best advice, against what I've been saying since, frankly, got elected, he was dumb and decided to take credit for a big fat stock market bubble that is now blowing up in his face just months before the election. But of course, if this really is, the end of days economically, we have a long way to go before we get there. There's the market has a long way to fall, but these early signs, and I shouldn't be so confident and say that this is the end or anything of this bull market, but things are looking really bad right now. It doesn't look like the Fed has much of an ability to affect the market at this point. And the Fed is all that's holding up this market. Remember, the fundamentals are crap. All you have to do is look at market cap to GDP. Okay, we were at 158% or something at the peak. That's nuts. Normal is well below 100%, but even 100% is, let's just say that is your baseline. We've got a long way to go before we get to 100% market cap to GDP. That's what the fundamentals would dictate, because you've got all these companies that are slowing, showing reduced earnings, and certainly they don't have enough earnings growth to justify this massive inflation in their stock price that we've seen over the last few years. So predictions moving forward, the Fed will get back to 0% at the very least. I think it'll be a while before they actually go in the negative route. I think the Fed needs to realize once and for all that that they're truly powerless to stop the next crash before they will resort to negative interest rates. I think that'll be a very big psychological step for them. But they've been mentally preparing for quite a few years, so I do think that it'll come this cycle. Now, the next thing is, of course, we already have not QE, which is essentially QE. The market regards it as QE, but the Fed does not regard it as QE. QE, of course, is quantitative easing, which is essentially the Fed just directly buying assets, injecting liquidity into the economy. The Fed will, in the coming months, perhaps sooner, announce a official return to quantitative easing. Another round, a quantitative easing 4, QE4. People have been anticipating this for years. I certainly have. I've been expecting it to come with this next recession in order to try and stop it. My suspicions are that since the market has already priced in not QE as QE, even the folks on CNBC say that the Fed is doing QE right now, QE4 will not save us. It will have a very limited impact because the market has already priced in QE. And so if cutting rates back to zero doesn't work and restarting, officially QE doesn't work, then the only choice that the Fed has left is negative interest rates. So with that said, I will continue to monitor this very volatile situation. Tomorrow probably we'll discuss the results of Super Tuesday. So if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.